Chapter 14, today we're going to see its continuation of chapter 13, obviously. But again, from chapter 13, what we learn is that the shareholders' equity have two main categories. One is the contributed capital, the other one is retained earnings. Now, the contributed capital, as we just mentioned, it comes from somewhere. Somebody has to contribute it. Who will contribute that one? That will be the shareholders. Who are the shareholders? Now it's a different story. The shareholders can be the owner of the company, but not necessarily, right? So what the shareholders can contribute, the shareholders can contribute cash, can contribute assets, anything that company can use for their operation. Because don't forget, the corporation is open, or the company corporation, public or private, for one purpose, to have a main operation, true main operation to generate income. That income to be converted in cash, and that cash to be distributed back to the owner of the company in form of dividend. So again, shareholders' equity is divided by two main components. One is contributed capital. We saw last time the contributed capital represents common shares, preferred shares, different classes of common shares, different classes preferred shares, and retained earnings. So now let's think about it and let's walk a little bit more. You already know that chapter 13, we covered the contributed capital, how we issue the shares. We talk about the cash dividend. For the cash dividend, you remember there's three dates which are important for the cash dividend: declaration date, date of record, and distribution date, or the payment date of the cash dividend. On the declaration date, the cash dividend become a liability for the company. And we saw the corporate balance sheet. So today, what we're going to cover, we're going to see retained earnings. We talk about a little bit more about retained earnings, repurchasing of shares, share dividend, and share split, and corporate income statement. So now, as you already remember from 1110, of course, by principles of accounting, first part, retained earnings comes from the income summary account. Now, income summary account at the end of the period, in the income summary account, we're closing all the revenue and expenses there. And the income summary account, the cumulative account, which may end up with debit or credit balance. If it end up with credit balance, which is preferable, that means sales are more than the expenses. If the income summary account ends up with debit balance, that means the expenses are more than sales. And after that, you have to close the income summary account into the retained earnings. So retained earnings, again, is the balance which is accumulated over time of the company. So retained earnings is the account that once it's started, the beginning balance of the retained earnings will be zero in the beginning of starting of the company. After that, it's going to be different than zero. So what's going to happen? It's all the net income minus the net losses and minus all the dividends. It's going to be the balance of the retained earnings year after year, every year after year. So if the retained earnings says, let's say this is the first year of operation, we're starting the operation this year, the retained earnings balance is zero. We're generating $100 income, and we decided to distribute it as a dividend to the shareholders, exactly $100, then the retained earnings is going to end up with $0. Now retain, what mean retain? Retain means holding it, or held onto, or kept. So why it's kept? Because we keep it in the corporation. Why do we need to keep that income in the corporation? Because sometimes you want to have a new operation, you have to start a new line of business, anything like that. If you kept that income that you're generating from the operation, the company, in the company, then you have ability to do something new. Otherwise, you have to generate new investments. So you have to get some new contributed capital from the investors. Now, important fact about the retained earnings is credit to retained earnings comes with the net income. The other interesting thing is retained earnings is not equivalent to cash. We already know income is not equal to cash. Why? Because in income you have so many accruals. It's the same story with the when you get the net income, which the net income is transferred to retained earnings, that's not equal to cash. Preferably, again, you want the retained earnings to end up with the credit balance, but if you see the debit balance in the retained earnings, that means you have a deficit. Ending retained earnings balance will be the beginning balance plus the net income on the credit side, minus net loss if there's a loss. Either you're going to have income, you don't have loss. You in the same year, you cannot have income and loss. That's impossible. But you can, once you have a net income, you can decide to declare dividend. So you have to deduct the dividend, and that's how you're going to get the ending balance. So retained earnings is very straightforward account. At this point, we're going to keep it very straightforward. Again, uh, beginning balance plus the net income for the period, less the dividend pay in the period, it's going to give you the ending balance. Now, is there any recipe how much you have to keep in the retained earning? It's not. There's no recipe for that. Don't forget, corporation is not obligated to pay cash dividend to the shareholders. It's not mandatory. It's not something that the corporation have to do. If they decide to do it, they can do it. So to declare dividend, there has to be a credit balance in the retained earnings. And for the cash dividend, we saw we have to have a cash. Can the corporation issue stock dividend? Yes, it can. Why corporation wants to issue stock dividend? Because the corporation currently don't have cash or preserve the cash for some different activities. Then they can distribute share dividend or stock dividend. Share dividend, again, that will increase the common shares now, and they're gonna decrease the retained earnings. Again, now you can see the difference. If we pay in cash on the credit side, we're gonna reduce the cash. On the debit side, we're gonna reduce the retained earnings, but on credit side, we're reducing the cash. First, we're gonna increase the liability account dividends payable, and then dividends payable, we're gonna eliminate it by reducing the cash. But with the stock dividend, on the credit side, we're increasing common shares. We're decreasing the retained earnings, increasing common shares. In other way, what we're doing is we're capitalizing the retained earnings. Why it's called capitalizing the retained earnings? Because when the retained earnings is converted to common shares, there's no way the shareholders to get the money. The stock dividend affect only the accounts with the shareholders' equity. So the total shareholders' equity in this case will remain unchanged. So let's see what the example is. This company declared 10% share dividend on 75 outstanding shares. So first we're going to check how much that 10% represents. Those 10% represents 7,500 new shares. Now we know how many shares we're going to distribute to the shareholders. Now we have to make a journal entry to record that shares. Now, how are we going to do? What we're going to use? So in this case, we're going to use the market value of the shares. We're checking the market value of the shares, and we see the market value of currently traded for those shares is $1.50. So 7,500 new shares times $1.50, that's 11,250. So what we're going to do, we're going to remove 11,250 from the retained earnings, and we're going to add it into the common shares. So the common shares amount increasing with 11,250. Retained earnings is reduced by the same amount, but total shareholder equity is not going to change. The next thing that's going to change is the number of the shares outstanding. Instead of 75, now we're going to have 82,500. Again, once we distribute the share dividend, we're saying that we capitalize the retained earnings. Basically, we transfer whatever company generating us an income into contributed capital. Now, as you remember, once the shareholders invest money and create contributed capital, the company has no obligation whatsoever to pay that capital back. Now, the transfer, the other thing that we transfer, how we're going to transfer the retained earnings into contributed capital, or usually the fair market value, which is the market value of the shares. What's the reason for the share dividend? Again, the share dividend first is company wants to preserve the cash. Why the company wants to preserve the cash? Maybe there's some capital decision that the company wants to explore, and for that reason they need cash. So instead of asking the shareholders to make investment or borrow money from the lenders, the company just preserve the cash and declaring a stock dividend. The other reason for the stock dividend may be because the company wants to reduce the market price per share. How is this possible? Well, if currently my market price for the share is $20 and I have 10,000 shares outstanding, if I increase the number of the shares, the market price per share naturally has to go down. So that's what I'm doing. I'm increasing the shares available to the market. Now, again, the share dividend increasing the number of the outstanding shares. Once we increase the supply, most likely we're going to reduce the price per share. And why we want to do that? To make the shares more affordable for the people and more attractive to the investors. How are we going to record the share dividend? As you remember, on the cash dividend, we have 3 dates. Date of declaration date, date of record, and payment date. Here, we have this, again, the 3 dates. Declaration date, again, which is announced by the board of directors. We have date of record, which we're checking who has the shares on that particular date. Whoever has the shares is on the record for that date, who is the one who's going to receive the stock dividend or share dividend. And then we have a distribution date. What's the difference? In the cash dividend, we have a payment date. In the share dividend or stock dividend, we have distribution date because we're going to distribute additional shares. Valuation of the share dividend usually based on the market value on the declaration date. which is suggested by Canada Business Corporation Act. Now, the share dividend, let's see the example here, assuming that this company has 40,000 common shares outstanding. They decide to declare 10% common share dividend on November 17th. They check the market value and they find out that market value per single share is $16 per share. Now, what they're going to do, how much are they going to distribute? They're going to distribute 4,000 new shares, which represent 10% of 40,000 outstanding. Now we have to see how much is the value of those 4,000 shares. Well, 4,000 times $16 per single share, and we're going to come up with a number of $64,000. So what we're going to do, we're going to reduce the retained earnings by debiting retained earnings for $64,000, and we're going to increase common share dividend distributable. Now, as you pay attention here, it says common share dividend distributable. That's on the distribution date. Now, what's the difference between the cash dividend? On the cash dividend, we went to the dividend payable, which is clearly liability account. Here, we're going to the different account, common share dividend distributable. That account is part of the equity section. It's not liability. So, on the date of record, we're going to check who actually owns the shares in order to distribute the share dividend. There's no journal entry on that date. And on the distribution date, we're going to record the issuance of dividends. Well, how are we going to do that? We're going to close this common share dividend distributable by debiting that account, and we're going to credit common shares. We're going to increase the common shares with $64,000, which represents 4,000 shares. Now, what's going to happen with the shareholders' equity? Before the dividend was declared, we have 40,000 outstanding shares with the book value $400,000 sitting in our books. We have retained earnings of $100,000. After the issuance of the shares, first we're going to reduce the retained earnings with 64,000, so the new retained earnings is going to be only 36. And then we're going to add 64 to the common shares, and we're going to increase the numbers of the shares issued and outstanding. The total, as you can see, total shareholders' equity, it's not going to change. There will be no effect on the assets and liability or the total shareholders' equity. What's going to change? Going to change contributed capital is going to change. Retained earnings is going to change. But the change on the retained earnings, decrease in the retained earnings, will be offset by the same increase in the contributed capital. Now, what is the share split? In order to show you the share split, I'm going to turn on my camera for a second. But let me see. What's my background? Okay. Let me demonstrate you with this. Okay. Now you should be able to see me somewhere on the screen, I hope. Can you guys see me?
Yep, I can see you.
There we go. So now let me demonstrate you share split. Now imagine this is a share. Can you see it? Can you see in my hands? This I'm holding. Pretend that this is a share.
Something you're holding, but it looks invisible to the
Is it?
background.
Oh yeah, because it's a bag. How about now? If I
Um,
put it close to me, can you see it? It's a sheet
y-
of.
yeah, when you put it in front of your face, like it's like you're going like,
Let me
you
see
know,
what
you're
what you're
blurring.
saying. I cannot. It's hard for me to see what you're seeing. because let me stop sharing then. Let's put the video. Can I see myself?
Whoa, that's very interesting. Only your face shows, like, and it's blurring and like,
Really?
yeah. Okay, now I think I partially see the paper you're holding. And when you
Yeah,
put it in front of your face, like the whole thing, the Douglas College logo appears,
I
and like you
see.
look invisible.
I see. Let me see. How can I see what you guys see? Anyway,
Just sent you the message of what I'm seeing. Like I took a
okay.
screenshot and I sent it to you in the chat.
Okay, let me see what is that. I see. Okay, so you cannot see the sheet. Okay, I see. Okay.
Okay.
Let me remove then the background. Just a second, let me adjust the background effect and let's remove it completely. Okay, so how about now?
Now I
Can
see the sheet.
Yes, we can see you.
now, so imagine this is a share. Pretend that this is a share. It's not like a sheet, it's a share. So I want to split this share. So what do you have to do? And I split it. So what I had before I have one share, now I have two shares. That's how you split the share. Make sense?
Yeah, that makes sense.
If I want, can I, from one share, so let's pretend I have another share. Let me grab another share. I have another share. I want to split this share one to two. What do I have to do? Get it and split it by two. Now, what's interesting now, imagine when it's only one share, the market value per share is $20. When I split it by two, what will be the logical market value of each of those shares? $10. Make sense? So, can I split this share, to four pieces? Yeah, I can. And now I have four shares. Again, if the market value for the single share was $20, and if I split it by four pieces, how much would be now market value? Most
Five.
likely it would be $5. Make sense? That's basically is the share split. Explained in the very, very uh, simple way. Let's put it this way, in the very simple way. So now let's go back to the slides. I'm going to share my screen with the slides, and let's see the share split now. Now the share split again is defined as increase the number of authorized and outstanding shares by proportional to reduction of the book value per share. Usually that's result of reduction of the market price per share. So what's going to happen? We will leave all the account balances and total shareholders' equity unchanged. Then what we're going to change? Just the number of shares. We don't need to do any journal entries for this. But the stock split, in this case, will be recorded as a memorandum entry on the notes to financial statements. Now let's say the example. This company has 400,000 shares issued. The market price for one common share is $100. The company wants to decrease the market value to $50. What do they have to do? They have to do the stock split 2 to 1 for every share to become two. What I'm going to do? I'm going to double now the number of the shares issued and outstanding by hoping by that the market price going to adjust to $50. If I want to adjust the market from 100 to bring it down to $25, what do I have to do? For every share, 421. For every share, you get 4. Now, think about something else. If I have one share, and that, let's say, 400,000 shares outstanding, issued and outstanding, I have 10%, I'm holding 10% of those shares. Make sense? So that means I have 40,000 shares. I'm own 10% of the company. After the stock split, let's say the stock split is 2-1. So now the new number of the shares is outstanding is 800,000 shares. What will be my percentage in the company after the stock split? Is it going to change or is it going to stay the same? What do you think? It's going to be the same. Why? Because after the stock split, I'm going to owe, instead of 40,000, I'm going to owe, uh, no, I'm going to have 80,000 shares. 80,000 shares will represent 10% of 800,000 shares. So by doing the share split, I want you to understand this, by doing the share split or reverse split, I'm going to explain in the later, just in the second, what's the reverse split. We're not changing the percentage of the ownership for the shareholders. They're going to keep exactly the same percentage. The example here will be, imagine again, after the split, there will be 800,000 common shares. So what we're going to do, before the split, we're going to have 400,000 shares issued and outstanding for $4 million sitting on the books. Retained earnings 1,800,000. Total 5,800,000. After the stock split, the only things that are going to change is now the common shares authorized double from 1 million become 2 million. Outstanding, issued and outstanding also double from 400,000 become 800,000. But the total book value of the shares, it hasn't changed. Now, reverse split is also consolidation. Now, unfortunately, I cannot show you a reverse split because there's no way I to put two pieces back to one. Right? They have to tape it and anything like that. But you're getting the idea. And in the reverse split is you're getting two shares, and that those two shares become one share. Why would I want to do that? Because most likely I want to increase the market value per share. So if the market value per share is only $1, and I want to increase it, double it to make it $2, what I'm going to do, I'm going to do the consolidation or reverse split. For every two shares, I'm going to give you one. Again, I'm not changing the percentage that you're holding from the company, but I'm just reducing the amount of the outstanding shares. And that's hopefully going to increase the market value to where I want to be. What's the similarity between the share dividend and share split? Both, it's going to increase the number of the shares owned by the shareholders. Both increase the numbers of the share issued by the corporation, and both will likely initially cause decrease in per share value. Neither of those will going to change investor total cost of the shares owned. What's the differences? Now, this is the interesting part. Share split, holding one versus two shares. If I holding today one share and tomorrow they do the split, and now I'm holding two shares, it doesn't create any tax consequences. Dividends, stock share dividends, on the other hand, when you receive the share dividend, you actually own taxes, and that creates tax consequences. Let me see what the question is. Does the share split only affect common share and not preferred share? It depends which one you're splitting. I can split common shares or I can split the preferred shares. Whatever you're splitting, that's what we're going to be affected. In this case, we're sticking only with the common shares. Now, the shareholders' equity, share dividend will shift the amount from the retained earnings into the contributed capital. Where the share split, it doesn't affect anything. So remember, if you the other thing that I want you to understand is shareholders they don't like share dividend. Why? Because if they get a share dividend, they don't get in cash, but they have to pay taxes, and taxes they pay in cash. So I'm not getting anything, and I have to pay taxes with my own money. It's not very nice thing to do. So most likely, that will can draw down your shareholders. If you give them cash dividend, then it's fine because they get in cash. With that cash, they can pay the taxes. But if you give them share dividend, they still have to pay taxes, but from their own money because you're not giving them any cash. Let's see what's the next thing that we have to learn today. How we're going to account for a repurchase of shares. So up to this point, we're talking about issuing shares. Let's see what's going to happen if we have to repurchase those shares back. Now, repurchasing the shares for the corporation, why the corporation wants to repurchase their shares for different reasons. One of the reasons may be because they need to recover previously issued shares. So if we need to distribute to office or employee under the bonus plan, we want to recover those one back, so we want to purchase them back. Or if you want to support the market price of the shares, we're going to decrease the supply of the shares available for the public, and that way we're going to increase the current market price. Or we may sense that somebody start buying shares and consolidating those shares with the idea to get more than 50% of the outstanding shares so that he can become a owner of the company. Or because we just want to meet some ownership requirements or limits. There's so many different purposes why the company wants to repurchase the shares. So let's see, Canada Business Corporation Act requires that all repurchased shares, once they repurchase back, so they have to be cancelled. Generally, repurchase is only allowed if the corporation has sufficient cash. So again, we're not going to repurchase our own shares by borrowing money. Only if we have enough cash, then we're going to repurchase our own shares. Repurchase shares, what's going to happen once we repurchase the shares? Those are going to decrease the corporation assets because we have to sacrifice the cash, and we're going to decrease the shareholders' equity. Now, in some provinces, it's required shares to be cancelled, where other provinces allowed they to be held. Now, once they held, they're called treasury shares. So if you see any of the multiple choice questions, let's ask you what's the treasury shares. Those are shares which are repurchased for the company and held as available for resale later. Those are your treasury shares. Now let's see the example of repurchasing the shares. Now, what I'm going to do now, I'm going to use this example here, and I'm going to move to Excel spreadsheet. and I want we to do those journal entries in the Excel spreadsheet together. Hoping that's going to help you to understand the idea better than just watching the slides and me talking about the slides. So that will be scenario 1 here. I'm going to share my Excel spreadsheet just in a second. Just give me a second. I have to do some modification here, make it a little bit bigger, a little bit wider, so we can start working on this. Okay, I'm ready to share my screen with you. And this is the question. So this company has the following items. Shareholders' equity has contributed capital, which constitutes of 100,000 shares authorized, 9,000 are issued and outstanding, and the corporation has retained earnings $24,000. Total shareholders' equity $2,400. Now, from the slide, before we moving further, what we can do is we can see that 9,000 shares are issued outstanding. Now, the question is, what's the average issued price per share as at this moment? Now we have 180,000 and we have 9,000 shares outstanding. That gives you average price per share of 180, 123 divided by 9, 123. It's going to give you $20 per share. Average issued price. Make sense? Are you guys with me?
Yeah, I'm with you. It makes sense.
Yeah.
Okay, so what's going to happen first? I'm going to copy from the slides and going to back to the Excel spreadsheet. So I'm going to keep you in the Excel spreadsheet. First things that's going to happen is not like that. Let's paste it like this. On March 20th, this company repurchased 1,000 shares at $20 per share. Make sense? So what's going to happen? The company is going to repurchase shares. Currently, the shares are outstanding. If you have to look the T accounts, in the T accounts, if we have to make the T accounts, the T account is going to look like this. Let me easily grab the T account. The bottom here and one more bottom here. And I need here one those. So my common share, contributed capital, that will be common share. I'm going to have beginning balance. It's on the credit side, as you remember. Beginning balance will be 180,000. That's what I have. Now, I'm repurchasing those shares. What that means? Do I have to increase this amount or gonna reduce it? Once the shares are repurchased back, obviously they'll be getting back to the company. Yes, they're gonna reduce. On which side we can reduce account that has a normal balance credit? On debit or credit?
Debit.
On the debit side. Excellent. So what we're gonna do? Once we're repurchasing share, we do debit common shares. And how much now we're gonna reduce that common share account? So first we're gonna repurchase back 1,000 shares, and the average price per share is $20. Correct? So how much we're going to reduce the common shares? We're going to reduce them with 1,000 times $20, or 20,000 will be our reduction. Let's move this one a little bit further. Let's put it right here. Now we have to create some accounts. If I'm repurchasing the shares from the people who currently own the shares, I have to give them something. And the only thing that they're going to accept is cash. So I have to reduce my cash. How much cash I have to pay? Since I'm purchasing back at $20, so I'm paying them $20. I'm paying 1,000 for 1,000 shares. I'm paying $20 per share. So my cash gonna go down with 1,000 times 20 with the same amount. Magically, we're in balance. Our debit is equal to our credit, so we don't have to do anything else. Make sense? Once I do this, now originally what I have, originally have contributed capital, and my contributed capital was the common shares, which I have 100,000 authorized, 9,000 issued and outstanding. That's what I have in the beginning, and that's 180,000. Let's put the dollar amount. Then what else I have? I have retained earnings. Uh, let's leave one space just in case here. That's 24,000. And my total shareholders' equity in this case is those two together. This one plus that one. That's my total shareholders. Now, after I purchase this, repurchase those shares, what's happened here? Let me copy this one and paste it here. What will be the new numbers? I'm still going to have 9,000 authorized, but now I'm not going to have 9,000 outstanding. I'm going to have only 8,000 outstanding, correct? Now my shareholders' equity is not going to be any more 100 and any longer 180,000. It's going to be $160,000. There will be no change in the retained earnings, and the total shareholders' equity is going to go down with $20,000. What else also going to go down? Cash is going to go down with $20,000. Make sense? So if I purchase here 20,000, repurchase back, my ending balance is going to be this one minus that one. You're going to have 160. That's the first option. When we repurchase the shares at the same price, which is the average issue price per share. It's always going to be that way. Unfortunately, no. So then we have to move to scenario 2. Let's move to scenario 2. Scenario 2, I'm going to go on the slides and I'm going to pick up the next scenario. The next scenario, we're going to move here. Now, our scenario up to after what we did, that's where we are. I'm going to copy it and I'm going to leave it here. What I'm going to do, I'm just going to copy from the slides the piece that I need and I'm going to share it with you. Now, on April 30th, Now we're gonna repurchase 1,000 shares at 15, and we're gonna pay $15 per share. Before we do that, let's check something. Now after we first purchase of the 1,000 shares, we are right here, correct? How much is my average issue price per share? Somebody says $20. Let's see if that's true. I have $160,000, which sitting as a value for my shares on the here. Also on the T account here, if we get the T account and we move it here, also going to show me that I have 160. Now my beginning balance 160. That's too much. 160, 1, 2, 3. And my number of outstanding shares is 8,000. So my average price will be 160 divided by 8,000. So it's $20 per share. Monica, you're absolutely correct. Now let's repurchase 1,000 shares. Once I repurchase 1,000 shares, again, I'm going to reduce the numbers of the common shares, correct? So debit common shares. Let's get rid of that 5 here. And how much I'm going to purchase? I'm going to purchase back, I'm getting back 1,000 shares. How much is my average price per share? We already calculated. My average price per share is $20. So that's how I'm getting back. So the amount that I'm getting back is 20,000. 1,000 shares times $20 per share. How much cash I'm paying, that's a different story. How much cash we're going to pay for those 1,000 shares? We're purchasing now 1,000 shares, but we're paying only $15 per share. Make sense? So we're going to spend 1,000 times 15, 15,000. That's how much we're going to spend. But now we're in trouble because my debit is not equal to my credit. I need more credit. What I'm going to do with that credit? Which account I should create? Well, this is very interesting account, and I want you to remember this account. Now, this is account, very specific account, and this account is created only and only when you're repurchasing back shares for for the um for the price less than original was invested from the shareholders. So basically, the shareholders pay $20 per share, and now repurchasing back, but they repurchase it at 15. And generally, it looks like you're gaining, but it's not gain because gain is consequences from buying and selling. In this case, you're selling it and then you're purchasing back. So for that reason, we're going to use this very specific account, which is called contributed surplus on the common shares. Make sense? And we're going to create that account with $5,000. And now we're in balance. I have 50,000 on the credit side and 20,000 on the debit side. Now, what's going to happen? This is my starting point. That was my starting point here. What's going to happen after this transaction? Well, we have to do some changes now. What will be the changes? First change will be the number of the shares going to go down. They're no longer 8,000, it's going to be 7,000. We purchased 1,000. They're going to go down with another 20,000. Now we're going to have 140. Then we're going to have a second account under contributed capital, which is contributed surplus common shares. And that account is going to have balance of 5,000. Sorry, too many zeros. 5,000. Let's leave one line here. Push it down a little bit. Then we're going to have retained earnings at 24, no changes in the retained earnings. So our total here will be 140 plus 5 plus 24,000. We're going to have 169,000. So as you can see, before this purchase, we didn't have contributed surplus. Now we have contributed surplus. Now my question will be, do you picture the idea with the contributed surplus? Imagine this. I have a cell phone. I have a cell phone. You want to buy it from me, and you offer me $100. I'm giving you the cell phone, getting you $100. Make sense? So now you have my cell phone, I have your $100. 2 days later, you find out that this phone is broken, and I'm coming to you and I say, I want to buy it back from you. And you say, okay, how much? I say $50. And you say, okay, it's broken anyway, so better get 50 rather than nothing. So now I'm giving you $50 back, and I'm getting my phone. But I'm keeping the $50 difference between the price that you pay me and now I'm paying you the $50. Make sense? So technically I'm making $50. But again, be careful with this concept, because yes, you can say that. But in this case, it's not gain. It's not income, because gain and income coming from buying and selling. In this case, is the opposite. First, you're selling something, then you're buying it on the price less than what you sell it. That's why it's called contributed surplus. I'm keeping those $5 per share that you pay me, that I'm paying now less, I'm keeping it. And that's become my contributed surplus. Make sense? Again, contributed surplus can be created only and only when you issue the shares and purchase the same shares on the lower price that you originally issued the shares. Only in that circumstances, no other circumstances. That's why it's very unique. Okay, let's move on to the next scenario now. This is one scenario to purchase the shares below the issue price. Obviously, the next scenario, most likely will be to purchase the shares above that price. Let's see what's going to happen now. Let's get the scenario 3. Now we in this scenario, we continuation. We keep gonna go with this idea. On May 10, now we're gonna repurchase 1,000 shares, but now we're gonna pay $30 per share. So since we're in this scenario, before we do anything, let's figure out first how much is our average price per share. What we have? I have $140,000 sitting on the common shares on the balance sheet, and I have 7,000 shares outstanding. So my average price shouldn't be changed, right? Average price will be 140,000 divided by 7,000. My average price is $220. Now, I'm gonna buy back 1,000 shares. So what I'm gonna do, same thing that we did before. So once we reduce it with 20. Let's keep this one. Now we have 140. Let's keep this one. Control C, Control V here. And let's keep going. Now I have 140. Now I'm purchasing back 1,000, which is 20,000. So debit common shares, 1,000 common shares at $20 per share. It's gonna give me $20, $20,000. So 20,000 common shares going down. How much cash I have to pay, that's a different story. Now, credit, cash, we have to pay for 1,000 shares, $30 per share. So how much cash we have to use? 1,000 times 30, 30,000. Now we're in trouble. Why? Because my debit is not equal to my credit. What do we need? More debit. Now the question is, which account I can debit? Listen this is the general rule. First, we're gonna check, is there any contributed surplus related to the common shares that we're repurchasing? If there's any contributed surplus, we're gonna use that contributed surplus until we use it all. If that's not enough, then we're gonna go to retained earnings. If we don't have contributed surplus, then everything goes to retained earnings. So the question here is, do we have contributed surplus related to common shares? And the answer will be yes, we do. So let's use that contributed surplus first. Debit. I'm just gonna copy this one, contributed surplus, common shares. And how much we have? We have 5,000. If I use 5,000 contributed surplus, is that solve my problem? Now I have 25 on debit side and 30 on the credit side. I still short 5,000. So which account I can use now? Now I can go to retained earnings. Debit, retained earnings. And how much I have to take from the retained earnings to balance it? 5,000. Once I do that, my debit is 30,000, my credit is 30,000, I'm in balance, problem solved. Now let's see what's happened with this part. Before this transactions, that's what we have. After this transaction, let's see what we have after this transaction. Now, 100,000 authorized, now not 7,000 outstanding, now they're going down to 6,000 outstanding. What's the book value? 120,000. Contributed surplus, that will disappear. Retained earnings is going to go down with 5,000. It's going to be 24,000 minus 5,000. And that's what we have. So one thing that I want you to see here is, compared to the previous scenario and where we are, how much is the difference? What's the difference between the original 169 here and 139?
30,000?
30,000. Why is 30,000? Because 30,000 cash gone. And we reduce everything with 30,000. What's the difference here between 184 and 169? 15,000. Why? Because that's the cash that we spent. So we reduced 20,000 common shares, but we added 5,000 contributed surplus. Difference is 15,000. Make sense? Well, what's going to happen if there's not enough balance in the retained earnings? Well, obviously, you can always use in the retained earnings. Retained earnings, as you know, it can end up with debit balance. If it ends up with debit balance, that means you'll be on deficit, right? Retained earning at some point can become, in this case, it might become negative. That means what's going to happen? So let's run this scenario. Watch this. Let's pretend. Let's go with this. C and Control V. What will be that scenario? Let me think of something. Let's pretend. Let's use this one. Let's play a little bit. This is again for the for the purpose of this exercise. Before I could do that, let me go back a little bit. Let's skip it this way. Let's move to the scenario, and that will be scenario 4. So this is our starting point, correct? And let's on May, Control C and Control V. Let's play a little bit. Let's say on June 10, we purchasing 1,000 shares, but we paying $100 per share. Make sense? Let's see what's going to happen in this case. We're going to have debit, average. We already know that average issue price per share. Let's check the average issue price per share, how much will be. We have 120,000 versus 6,000. Average issue price should be 120 and 6,000. It's going to be $20 per share. If we have to get this common shares here, let's move it 120 and let's move it here. Sorry, wrong place, like this. So starting 120. So we're going to purchase 20. We're going to reduce with 20. It's going to be 100. Let's do that. Debit, common shares. And that will be, is it possible for shares to have accrual or any type of adjusting entry? Accrual, no. No, no such thing. No adjusting entry for the shares. Everything is real here. 1,000 shares, $20 per share. And we're going to retire those shares. 20,000. It's going to retire. How much we have to pay? Now, that's a different story. So credit, cash, and we have to pay 1,000 for 1,000 shares. We have to pay $100 per share. So how much we're going to pay? That's a lot, isn't it? 1,000 shares times $100 per share. We're going to pay 100,000. 100,000. That's too dramatic. Let's reduce it. This one, if it's 50, let's go with $40 per share. 40 to be a little bit more realistic. Let's go with $40 per share. $40 is still gonna serve our purposes. $40 per share. That means here 40. So now we have a difference of 20. We're out of balance with 20,000 on the debit side. What was the general rule? First, we check is there any contributed surplus related to these common shares. There's nothing. So we cannot use contributed surplus. We don't have anything. Then where are we going to go there? We're going to go to retained earnings. And we're going to debit the retained earnings with 20,000. Okay. After we do this, now we unbalance. Everything's fine. Let's see what's happened with the shareholders' equity. This is the original scenario. After that, we have 100,000 authorized. We purchase 1,000 again. So now we have only 5,000 outstanding. At $20, 100,000, 20,000 going down, $100,000 is our balance. Now retained earnings started with 19,000, but now we're going to reduce it with 20,000. So now my retained earnings is going to move to the debit balance. What's happened now with the shareholders' equity? The money that you invested in the company, if we dissolve the company right now, you're not going to get it back. You're going to get 1,000 less. Why? Because you pay too much for what you get. Make sense? How much is the reduction of the total shareholders' equity? Can you see it? 40,000. What's the 40,000 represent? The cash. And now your shareholders, instead of, yes, you have common shares for 100,000, but you're not going to get 100,000. You're going to get only 199,000. That's what will be very unfortunate, unfavorable situation for the shareholders. If this happen, most likely the company is going to go. If we keep going the same, I mean, retained earnings in this case, you still have a chances. This is not the end of the company. Don't get me wrong here. You can create a negative debit on the retained earnings by purchasing, paying higher price than what you get originally. As you can see, you pay 100% more than what you get. But if the company is profitable, then through the income, you can improve the retained earnings. But if you generate negative retainer or debit retained earnings from the main operations, means you're generating loss, 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 2 years with loss, that probably will be end of the company. Okay, that's enough with those. We cover all the scenario. First scenario, again, we repurchasing the shares at the original price that we issued the shares. Second scenario was we purchasing the shares below the price that we usually issue it. So we creating contributed surplus. Third scenario was purchasing the shares above the price that we issued and using the contributed surplus first to bring it down to zero and then using the retained earnings. And the fourth scenario is repurchasing again shares above the price that we issued without having contributed surplus. And
Sorry, I have a quick question. You will
yes,
put this to Blackboard, right?
yes, of course.
Okay, thank you.
So let's stop sharing this Excel spreadsheet and let's move to our slides. Let's cover quickly the slides now. Again, we're starting with the average price. Let's repeat everything quickly. First, we're purchasing 1,000 shares at $20, with reducing the common shares with 20,000, and we're paying exactly the same amount. So our shares, as you can see, original common shares was 180, now moved to 160. Number of the shares went down with 1,000, no changes in the retained earnings. Next scenario was we purchasing the shares at 15, which is below the average issue price per share. So that's how we're creating that contributed surplus. So what's going to happen here? We're going to retire 20,000 common shares, debit common shares. We're going to pay $15,000 cash, 1,000 times $15, and we're going to create that contributed surplus of 5,000, which is present $5 per share, which we're paying less than original amount that we get for those shares. What's going to happen with the shareholders' equity? Again, from 160, we moved down to 140,000. We're going to have now 5,000 contributed surplus. Retained earnings, no changes. Next scenario, we're purchasing the shares above the price that we issue the shares. Now, first, the rule is, first, if there's a contributed surplus related to that particular type of shares, use it. If you still need more on debit side, go retained earnings. So for that reason, first, we're using the 5,000 contributed surplus, and then we're adding another 5,000 from the retained earnings to balance it. After we do that, what's going to happen? From 140,000, we're going to go to 120,000. 5,000 contributed surplus will disappear, and retained earnings is going to go down with 5,000 to 19,000. So again, when the shares are repurchased at the price above the average issue price, the rule is, first, check is there any existing contributed surplus related to the shares that you're repurchasing. If there is, reduce it to zero. If it's not enough, then go to retained earnings. Because sometimes it might be enough. Again, the general rule. First one is when you're purchasing, Repurchase price is equal to the average price. Debit is equal to credit. You don't need anything. Repurchase price is below that average issue price. Then you're creating the contributed surplus. When the repurchase price is above the average issue price, then first, if there's a contributed surplus, use it until you bring it to zero. If it's not enough, use retained earnings. If there is no contributed surplus, directly go to retained earnings. What will be additional issue with those repurchase shares is if the repurchase shares are sold at later date. I'm not gonna bother you with this one uh, because technically by Canadian Corporation Business Act that's not allowed. So we're gonna leave it here. Let's have a break a little bit because I understand this purchasing, repurchasing, above, below. It's a little bit. It's very straightforward if you think about it, but I'll give you some time to process it first, and we after that we're gonna continue with other issues. Sounds good?
Yeah, that's a good idea.
Okay, let's take a break. Uh, how many minutes break you want? Slides 31, no, it's not going to be tested. 10 minutes, okay. Let's do 10 minutes break then.
Um, I've been sorry. Is this a good time to ask you a question?
Sure. If you don't mind
So
the other people listening, that's fine.
yeah, that's totally fine.
Okay.
So because I missed my first class with you, I
Yes.
was wondering if there's any way for me to like if there's a good way for me to catch up
There's a
or
recording
recording.
posted
Okay.
on Blackboard.
And what about handouts? Like
The handouts,
market.
the handouts will be on the posted in here. If you go to, let me share my screen just a second.
Okay.
Let me open Blackboard and I'll show you what they will be. Mm, okay, okay, okay. Got this course. Let me share my screen now. Sharing this one. Can you see my screen?
Yep.
Okay. Let's start again then. Net income is probably the most important piece of information about the company. Measure the company's success, help the investors to decide should they invest in the company, and build the assets and shareholders' equity. Now, again, we're talking about the corporate income statement here. The corporate income statement is going to have a different sections. Each section is going to have different calculations. First calculation always and always going to be gross margin. You're going to have the sales revenue, cost of goods sold, gross margin. That's your first calculation. Second calculation will be operating income. You're going to have operating expenses, and then you're going to show the operating income. Now, once you get the operating income, then you're going to have some other gain and losses, which are part of the continuing operations of the company. Continuing operation means that operation that's going to keep going next period and next period, and next period. So for that reason, we're going to separate it on the other gain and losses. Loss for the restructuring operations. We restructured some operation, we create loss. We sold machinery. We purchased a new machinery, we sold the old one, we're getting 42,000. And then we're going to have income from continuing operations. Then we're going to show income tax expense. And we have income from continuing operations. Now, interesting part is this, and remember it. Once you show income tax expense, if the income continue further, there will be no more income tax expenses. Only on one place you can show income tax expense. You cannot show here income tax expense and after that another income tax expense and another income tax. There's no such a thing. What that means? That means any other amount that's going to be included in the income statement after the income tax expense, it has to be shown as less than income taxes or net of income taxes. So let's observe here. Sales revenue, cost of goods sold, gross margin. Operating expenses, operating income is calculation. Then we have other gain and losses, which are related to continuing operation. We have income from continuing operation before income taxes, income tax expenses, income from continuing operation. That's a normal income which company generate from continuing operation. Then we have a discontinued operation, which those discontinued operation, that's never going to happen again. Now, operating income from this discontinued operation was 60,000. We're going to deduct the taxes right here, and we're going to show net of taxes 39, inclusion. Gain of disposal, 10,000, less the tax. And we're going to show net of taxes, 45,000. Net income for this company is $162,500. The next thing that we have to show is earnings per share. Now, the earnings per share has to be shown on the income from continuing operation and on the income from discontinued operation and from the net income. As you can see, earnings per share from the continuing operation is $95. Income from discontinued operation is adding another 76 cents. Total earnings per share on the net income is $2.71 per share. So from the $62,500, every share is going to get $2.71. Now let's go continue operation. Continue operation helps to make a prediction about the future earnings. Why? Because we expect those one to continue next period and next period and next period. We're including the results from the normal operating activities. Also, I'm going to include gain and losses from selling and buying machinery, which is not part of the main operation of the company, but is part of the ongoing operation of the company. And it's going to show also income tax expense. Discontinued operations is going to show something that's not going to happen again. Once it's stopped, it's over, it's over. So it has two sections, as you can see here. First is operating income from the segment that is disposed or discontinued. And the next one is the gain on the disposal of the assets in that particular segment of operation. So basically, we discontinued that operation. That's never going to happen again. We're not going to get, but we just, at this point, we're getting what we can, and that's all. Interesting thing, since this is after the income tax expense, the amount has to be shown at the net of tax effect. And the last section that we talked about was earnings per share. Now we're gonna do some earnings per share calculation. Earnings per share is net income minus the preferred dividend, which we owe to preferred shares, divided by the weighted average numbers of the common shares outstanding. This is the key here, weighted average number of the common shares outstanding. What that means is, now the corporation can issue shares at any point, can repurchase the shares at any point. So we have to weight it based on the time that was outstanding or not outstanding and see how much is over the entire period. It's not simple average, it's a weighted average. Now let's do some practice on the weighted average. See, this company had the following common shares outstanding on the respective days. From January to May, they have 240,000 shares. From June to August, they have 200,000 shares. From September to December, they have 210,000 shares. Now the question is, what's the weighted average number of the common shares outstanding? So there are few ways to calculate this number. I'm going to get this information here. I'm going to copy it and I'm going to move to Excel spreadsheet. And we're going to do it together. Before we start doing it, just want to do some formatting here on the Excel spreadsheet so it can be more useful when you see it. And we can start using this. Okay. So I can share my Excel spreadsheet with you and you can see the calculation here. Okay, now assuming that this corporation has the following common outstanding shares. First, what we have to do is very, 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 very simple. We're gonna from January to May. So we have January to May 240,000 shares outstanding. So what we can do, I can do here months. That's one option. Months outstanding. Which shares was outstanding. Then we can get the number of shares. How many shares was outstanding? And then I can get total. This one is bother me. Let's get here. Let's shrink it a little bit this way, and I can get here total. Now, from January to May, how many months we have? You can use your fingers. January, February, March, April, May, including. We have 5 months, correct? Number of shares were 240,000. Let's put it here. So the total, I can easily calculate that total over the 5 months time 240,000. It's gonna give me 1,200,000 shares. Then I have from June to August. June is 1, July 2nd, August 3rd. So I have 3 months. And I have, for those 3 months, I have 200,000 outstanding shares. That give me number 600,000. Then the last thing is from September to December. So I have September, October, November, December, 4 months. I have 210,000 outstanding shares. That's going to give me a total of $480,000. So what's interesting here for me? First, I already know the year has 12 months, correct? So my total here has to be 12. If it's not 12, then I make a mistake. So I get the total. Second, I'm gonna get the overall total of the everything outstanding. And then I'm gonna get this total divided by 12, and I'm gonna get the weighted average outstanding shares. Weighted average outstanding common shares is equal to the total amount divided by the number of months that in total they are outstanding. It's going to give 220,000 shares is a weighted average outstanding common shares for the year. That's one way to do the calculation. Now there's a second way. Let's copy this. I'm going to show you the second way. For the second way, we're going to do this. We have months. We know how many months we have a year. Year has 12 months. Then we're going to get the fraction for the year. Then we're going to go number of shares, and then we're going to calculate the total. Let's see how this is going to work. So first, for January to May, again, 5 months, 12 months per year. My fraction here is 5 divided by 12. This is my fraction. How many shares I have? 240,000 shares. So calculation will be this fraction times 240,000 shares. Second one, from June to August, I have it for 3 months. Divided by 12, I'm going to get that fraction for the part of the year. I have 200,000 shares, so the number here will be 50,000. And the last one is 4 months, September, October, November, December, divided by 12. My fraction here is 0.33, 210 outstanding. I'm going to get this total. And my total weighted average outstanding shares in this case is again 220,000. Now once I get this number, I don't have to divide it by 12 because it's already reflected by 12. So this one, in this case, it has to be equal to 1. If it's more than 1, you're making mistake. If it's less than 1, you're making mistake. If it's 1, the fraction is 1, you're perfect. So this is one way to do it. Sorry, not this one. This is one way to do the calculation. This is second way to do the calculation. Now there's a third way to do the calculation. Now the third way will be way more interesting. So first one, we're assuming that from January, so let's go with this. In January, we have 240,000 shares, correct? So from January to May, for 5 months, let's go again with this calculation here. I can use this one. For 5 months, I have 240,000 shares. Then in June, I reduce the numbers with 40. Can you see that? From 240,000 shares, they went to 200,000. So for 3 months, I have minus 40,000. And then in September from December, I increase it with 10,000. Now, what I have to do is, this one is not going to work. Sorry, I'm making some mistake. So that will be 12 months here. I'm still making mistake. In the very beginning, you have 240,000, which stay for the entire year. Then for the June, sorry, yes. From June to December, now we have to increase the number of the months. I have to increase the number of the months to 6 in order to catch it. I'm gonna show you this calculation. I cannot get exactly the numbers. I don't wanna spend too much time on this one. Let me double check on the calculation. But no, they show you only one way to calculate it. Let me pick something else, and I'm sure get back to you. I wanted to check on the Blackboard. There's a calculation for you posted, just to see how exactly this one was calculated. Just give me a second, and I'll be with you right away. The way the question is given, it's giving me a little bit problem for the calculation. Usually the questions that you're going to see is not going to be exactly how many outstanding, but they're going to say, at this point, that's how many was issued. This many, or this time, that's how many was issued. That's why I'm trying to find some calculation here, earnings per share calculation, so I can show you exactly how is this done. Let me see if this is gonna work. Just a second. Yes. Okay, so now I can explain it to you. Let me share my screen again. Okay, watch this. First, another way to do this calculation. We are assuming from January to December, for the entire year, we have 240,000 shares. So for the 12 months, I have 240,000 shares. Total, it's going to be equal to 12 times 240,000 shares. Then from June to December, I have 200,000 shares because in June I repurchase 40,000 shares. So that will be June, July, August, September, October, November, December. That's 8 months. I have 200,000 shares. The total will be, sorry, not that one. Total will be that much. And from September to December, I have 210. That will be 4 months, 210,000. And that total here will be that much. Uh, no months here, 24. If I get this one divided by the total, that one, it's not the same. I get a different way the previous. So for the 12 months, I have 240. From June to the entire December, I reduce it with 40,000. That will be minus 40,000. And then from September to December, I increase it with 10,000. So my number here, it's gonna be 8. So June, July, August, September, October, November, December, 8 months. And September, October, November, December, 10. 260. I'm missing 40,000. That's not 5. 4,000. So just a few minutes ago, I get it right. I don't know where I'm making mistake now. There's so many calculations. That's why it's confusing. But I'm sorry that I think I'm messing with your minds right now. This is the calculation that I'm getting. So from June to December, June, July, August, September, October, November, December is 7 months. 7 months. So 7 months. For the 12 months, I have 240,000 shares. For the 7 months, from June to December, I reduce it with 40. And then in September, I increase another 10,000. So that give me 2,640,000. And that divided by 12, it's going to give me the same average that I have. Weighted average uh, outstanding common shares is 222,000. That's the right answer in this calculation, 222,000. Sorry, uh, sorry for taking me so long for this calculation here. But again, choose one of the methods. Obviously, you're not going to choose this method because this, if you give me trouble for me, obviously it's might give you trouble for you. But if any of those one you find it a little bit easier, use any of those methods. Under each method, you're going to get exactly the same number of weighted average outstanding common shares. Once you get that number, you can easily calculate earnings per share. So let's go back to the slides. Let me find the slides now. Here we go, the slides. So on the slides, what they're using is they're using the fraction, 5 divided by 12. Now, how can you use the fraction? You can use it right here, or you can use it at the end. It's nothing gonna change. The calculation will be the same. So 245 divided by 12, 203 divided by 12, and 210, 4 divided by 12. Then you're getting weighted average 220,000. Now, what's going to happen if you have the share dividend? Now, one thing that you have to be careful is, once you have the share dividend, you're applying the 10%. If they give you the 10% on September 31st, from September until the entire year, you're applying the 10%. 10% of, so you're going to get 240,000, 200,000, and then you have, on this example, you have 210,000. 10% we're gonna be 21. So when you're adding 21 to 210, it's gonna be 231. So the 231 now become outstanding, including the share dividend for the remaining of the year. Now, what you have to do is to make it equal for the entire year, you have to go back and apply that effect of the share dividend for the previous number of the shares. And then you're going to get the weighted average number. That's one way to do it. The other way to do it is at the end of the calculation, pretend that there is no share dividend. Let me share my Excel spreadsheet here. The other option is do the calculation the way it is, pretend that there is no share dividend, and at the end, add the share dividend. Let's say the share dividend is 10%, and apply the 10%. So get this number time 1 plus share dividend, and you're going to get the number of the weighted average outstanding shares with the share dividend. That's another option. Again, choose which one is easy. Either apply it at the very last point, affect those one for the 4 months, and then go back and adjust for the previous period when there was no share dividend, or pretend that there was no share dividend, and at the end of the calculation, add the share dividend. The next thing is for the share split. Share split, you have to apply the same logic as a share dividend. If you're doing on September, you're doing the shares split 2 to 1. That means you double the outstanding shares. You're doing the calculation for September to December using the actual numbers. But for the previous months, you have to go back and adjust for the share split in order to get the number for the weighted average outstanding shares. The other option is pretend that there's no share split. At the end of the calculation, add the share split. 2 to 1, double the number of shares, and you're going to get the result. So the earnings per share, preferred dividend must be deducted in order to calculate earnings per share. So you're getting the net income, deducting the preferred dividend, whatever left divided by the numbers on the weighted average number of shares that you're calculating, and you're getting the earnings per share. Earnings per share is basic and diluted. In this course, we're not going to talk about diluted. I'm not going to teach you how to calculate the diluted earning per share. I'm just going to explain what diluted means. Basic earnings per share is the income which is attributable to the outstanding common shares. That's your basic earnings per share. Now diluted, it represents the earnings per share based on the outstanding common shares plus any available options, stock options, convertible preferred shares into the common shares, pretending that if they are exercised at this time. One thing that you have to remember, basic earnings per share is always gonna be higher than the diluted. Why? Because in the basic earnings per share, the number of outstanding common shares will be less. In the fully diluted, you start working with the number of the outstanding shares, and that number naturally is going to increase. If that number is increased, diluted earnings per share naturally is lower than the earnings per share. Price earning ratio is the market value of the share divided by the earnings per share. So if the market value of the share is $25, divided by the earnings per share that you calculated, it's going to give you the price earning ratio. And that's with the income and earnings per share. Now let's see what's going to happen here with this retained earnings and statement of the shareholders' equity. Now the retained earnings, again, retained earnings gonna have calculation will be beginning balance of the retained earnings plus net income less dividend is gonna give you the ending retained earnings. For the statement of the shareholders' equity, we're gonna apply the same approach. We're gonna have the beginning balances of the year for the common shares, contributed surplus to the common shares, retained earnings, and total shareholders' equity. Now, as you can see, we have the calculation on the horizontal and we have the calculation vertical. Once you add it horizontal and vertical, the total has to be the same. Now here we don't have preferred shares, but if we had preferred shares, the preferred shares will be listed before the common shares. Why? Because they're higher rank than the common shares. First always come preferred shares, then we get the common shares, then the contributed per surplus, and then retained earnings, total shareholders' equity. As you can see here, the balances was in the beginning of the year. Then what's happening with this company? First, they issue shares for $100,000. Then they have net income, which increase the retained earnings. Then they declare cash dividend. Retained earnings goes down. And then we repurchase the common shares. Now, the common shares went down, but contributed surplus was created. What that means? That means that they repurchase common shares below the original price that was collected for they sell the shares. And they contributed $10,000. Now on the retained earnings, as you already know, the company, the corporation is not required, it's not mandatory for the company to distribute the retained earnings as a dividend to the shareholders. For that reason, there might be some restriction to the retained earnings. First restriction might be legally through the Incorporating Act. Second restriction can be voluntary. The voluntary restriction is also called appropriation, means that management of the company may decide to restrict the declaration of dividend, restriction of the dividend, because they want to preserve the retained earnings for some expansion of the company or some new project, or they can explore new markets or anything like that. The legal restrictions to the retained earnings will be obviously in the form of dividend. The bank can put some restriction on the dividend. For example, if the bank lend you money, obviously the lender wants first to recover their principal. Now, if you generate income, if you owe me money, is that income yours? Well, technically, it's yours, but you owe me money. So it, in some way, indirectly, it belongs to me. So for that reason, I don't want you to give yourself a dividend until you pay me the loan in full. Once you pay me the loan, you can give yourself a dividend. So what I'm trying to do, I'm restricting you from getting dividend because for dividend, you're going to use cash. So instead of paying me cash for the loan that you have, you're giving yourself as a dividend. I don't want that to happen. For that reason, I'm going to give you the loan, but on the loan, it's going to be a restriction, which I can easily impose through the contract of the loan to say there will be no dividend to the shareholders until the loan is fully paid. That will be a legal restriction for the retained earnings. Accounting for the errors and changes in the policy. In the intermediate financial reporting second part, you're going to talk more about diluted earnings per shares first, and you're going to talk about accounting for errors and changes in accounting policy. Here we just very briefly we're going to mention that since this course is in the accounting standard for the private enterprises, accounting for the errors in changing accounting policy, there's a two way to treat them. One is retrospectively, which is we're going to go and adjust the retained earnings. So imagine this. We find an error from the previous period, which has not been corrected during that period. Now, for that reason, the income statement is incorrect. Now, we're not going to restate the income statement because changing the financial reports after the year end, it's very confusing to the investors. So then what we're going to do? Well, that income end up in the retained earnings. So instead of changing the income, we're going to go and we're going to adjust the retained earnings directly. Once we adjust the directly retained earnings, we catch that mistake. So with adjustment on the retained earnings, we're dealing with the retrospectively. We're going to adjust that when we have errors from the previous period and when we have a change in the accounting policy. Prospectively means moving forward, retrospectively going back in the past. Prospectively is moving forward. We're going to account for changes which are due to the estimate, which are due to the current circumstances. Prospective treatment is done when the accounting information is found more useful and we are adjusting the current estimates. For example, next chapter with next time, not next time, actually yes, next time we're going to start talking about property, plant, and equipment and long-term assets. So on the long-term assets, when we talk about, we're going to talk about amortization. When we collect the information initially for the asset, we may come up with the asset to have a useful life of 5 years. We're going to calculate amortization based on the amortizable amount over the period of time. But later, after the third year, we may find out that this asset actually is not going to last 5 years. It's more durable than we expected. It's going to last 8 years. So now we have more useful information. But And we're going to add 3 more years to the life of the asset. And that's going to change the amortizable amount. But we're not going to go backwards retrospectively to change all the expenses that we did as a amortization expense up to that point. We're just going to adjust the numbers prospectively, and from that point of time, when we have more useful information, until the end of the life of the asset, we're going to adjust the numbers. So let's go with the accounting for errors and see the example. Let's assume that this company recorded the closing the inventory balance as $30,000, but the correct amount was 40,000. Now this error means that we overstate the expenses with 10,000. If we overstating the expenses, that means understating the net income. So we're not gonna go and change the income statement. We're gonna add the $10,000 to inventory, and since that income, understated income, went to retained earnings, we're gonna go directly and adjust the retained earnings and increase the retained earnings with $10,000 to show the effect of the increase in the inventory, which is current asset. So how is this going to be presented? Retained earnings of the year is going to be reported. Then we're going to have adjustment related to correction of the closing inventory, adding 10,000. Now the new retained earning adjusted will be 40,000. And then we're moving forward. Current year net income is that much, dividend that we declare is that much, retained earnings for at the end of the year is the calculation between those two numbers. And that's how we're dealing with those situations. Now, the differences between international financial reporting standards and accounting standards for the private enterprises. Again, at this point, you don't have enough information for the international financial reporting standards. So we're talking mostly about the accounting standard for the private enterprises. So once you get a little bit more idea of the international financial reporting standards, then everything is going to make sense. I strongly suggest you to keep those slides somehow, and when you're moving to the intermediate financial reporting, bring those slides and see how exactly it was different events was treated under the accounting standards for the private enterprises. And that will be the end of the slides. So now, what I'm going to try to do now is just a second now. I want to check some of the questions that I'm posting, the practice questions that you have here. And I want we to do a few questions about calculation of earnings per share. More specifically, I want we to do this question. I'm gonna download it just for a second, and I'm gonna post it here on the screen, and I want we to go over these questions. So we can practice a little bit calculation of earnings per share. And more specifically, the whole point is we to calculate the weighted average outstanding shares. Okay? That's the objective. Let's see, I think there's some comments in the chat room. Let me see if there's a questions. Okay, let's go now. I'm going to share my screen with the question. First, let me show you which question I'm doing so you can download it by yourself. On the Blackboard, if you go Blackboard on the chapter 14, there's a practice questions. If you check here. The first one is the earnings per share calculation. And then we're going to go to chapter 14-01. This is the set of questions that I'm going to show you right now, and we're going to start working on those set of questions. So those questions are right here. Let me share my screen. Those are the questions. So let's make it bigger so you can see it. So the company had 70,000 shares of common stock outstanding through the year. Net income was 99,600. Earnings per share for this company will be, first we have to find out how much is the net income. Obviously, the net income is 99,600. Weighted average common shares outstanding during the year, there's only 70,000. So how much will be the earnings per share here? That will be very simple calculation. With 99,600 divided by 70,000 is going to give it a number. Now let's go with the second question, and let's copy this, and I'm going to move now to the Excel spreadsheet. So we can use the Excel spreadsheet for our calculation. Let me open one Excel spreadsheet, and I'll close these questions. Let's make it a little bit bigger so you can see it once I share my screen. Okay, I'm ready to share my screen with you. So let's go over this question quickly. So the company had 30,000 common shares outstanding on January 1st. On March 1st, this is more common question. On March 1st, the company issued additional 18,000 common shares. Net income for the year was 99,000. The earnings per shares, we have to calculate the earnings per share. So we need the net income. Net income, we already have it. Net income is 99,000. Now the next thing that we need is weighted average. Why this one doesn't work? Let me just double check. Here we go. That's better. Number. Now we need to find the weighted average common shares outstanding. So let's go with the period or months. Company has 30,000 shares outstanding from January, outstanding in January. On March 1st, company issue additional 18,000. So they have 30,000 from January and February, correct? That gives us 2 months. Are you guys with me?
Yeah, I'm following you, Ivan.
So, first thing first, for the first 2 months, they have outstanding 30,000 shares.
Just a quick question.
Yes.
It does not say February on the screen, but like I'm guessing since they say March 1st, we account for February as well. Is that the reason why we count
No.
in February?
So March on March 1st we issue additional 18. So the question is for how many months we have 30,000 shares outstanding,
Oh, okay, that makes a lot of more sense. Thank you.
right? Only January and February. Now on March 1st we issue another 18,000. So from March, and that's the last issuing, from March all the way to December, our total number of outstanding shares will be 18,000 more, or 48,000, correct? But for how many months? For 10 months. Because don't forget, the year has 12 months. I cannot go more than 12. Make sense? So now I have to find the weighted average. That will be the number of shares. And that will be my total. So the total here is 2 times 30,000. And then I have 10 months times 48,000. So my total of shares is 540,000 for the entire year. Weighted average, common shares outstanding, it's going to be equal to 540,000 divided by 12. So you're going to have 45,000 weighted average. So the 45,000 comes here. So how much will be my earnings per share? Earnings per share in this case will be 99,000 divided by 45. It's going to be $2.20. Make sense? So
Yeah.
where you're going to see the answers for those questions, if you scroll down on the sheet, let me share my screen with the questions. If you scroll down on the second page, you're going to start seeing the answers. Let's go with another one. Let's do one a little bit more complicated. Let's choose this one. And again, I'm going to go to the Excel spreadsheet. I saw one comment that you like using the Excel spreadsheet. Is that correct? By using Excel spreadsheet does make it a little bit easier for you. What are you guys saying? Yes or no?
I like the Excel spreadsheet.
Only one person like it, or most of you like it?
Yes, yes, it helps.
Okay, so now we have this. Let's move to those one. And here I'm gonna post those things. Now, what we have here, company, we need the same format here to get the calculation. Gonna flip it here, and we're gonna start plugging the information. Maybe we need to have more, a little bit more. Let's go this company. Company had 30,000 outstanding shares on January 31st. Okay. Additional 10,000 shares was issued and sold on June 1st. So the 30,000 stays from January all the way to June 1st, which is January, February, March, April, May. 5 months. 5 months I have 30,000 shares. Then I'm selling 10,000 more in June 1st. Now let's see from June 1st, and the last one is that 20,000 was issued and sold on December 1st. So from June to December, I have 10, 30 plus 10, 40,000. So how many months are those? June, July, August, September, October, November. 6 months. 6 months, I have 40,000 shares outstanding. And for 1 month, only December, I'm issuing another 20. So I have 60,000. So where are my totals? First I have 5 times 30, 150. Then I have 6 times 40, 240. Then I have 1 times 60, 60. My total number is 550,000, 450,000 divided by 12. My weighted average common shares outstanding is 37,500. So where is my net income in this case? My net income is 120,000. My weighted average is 37,500. So my earnings per share should be this one divided by that one as a dollar amount, $3.20. So let's check the solution. Are we on the right track here? If we go down, we're gonna see that in this solution we have 120,000, 37,500, earnings per share 320. And keep going and keep going, keep going with these questions. Get comfortable. I strongly suggest you in this course to get comfortable with calculation that of the weighted average common shares outstanding, because that's going to save you a lot of time on the intermediate accounting too. Use this course, practice. Find which method is easier for you. Here I'll show you the calculations. I'll give you one method, second method, third method. You have the 3 methods here. Let me show you, let me share my screen so you can see it, where you have those one. On the Blackboard, if you go to Blackboard, under the practice question, chapter 14, practice question, the very first document, earnings per share calculation. And here you have example where the company has that many shares. In addition, 3,000 shares was issued at this point, and this happened, and this happened, and this happened. You have 3 methods. Find which one is the easiest for you and use it and stick with it. You don't have to move to any other method and get these numbers. All the methods going to give you the same weighted average common shares, outstanding shares. Make sense? If you have to save this document, save it. Again, in the intermediate accounting second part, when it goes to the, I don't know who will be your instructor and who's going to teach you for that one, but keep this document. And when you see questions for the common shares, for the calculation weighted average number of the shares outstanding, use it, easily calculate it, move on. There's a lot of questions that's going to come on the intermediate financial reporting on the calculation weighted average number of shares. And now is a good time for you to practice and to get it, understand it, and move on. Is the earned or retained earning itself net income? It's more correctly to say that isn't the net income retained earnings? Yes, the net income goes to retained earnings and stays there. Now the company decides, is it going to use it or not, for what purpose it's going to use it. Why the statement has the retained earnings? Because we're doing the statement for the retained earnings, and the retained earnings including the net income. Questions, guys? We're done with this. Yes.
Oh, sorry. When we're talking about contributed capital, that when the company issues shares to be sold, and then the the funds that they get from selling their shares goes into contributed capital. So does that mean when you buy, say, one Apple stock, does that mean my money from buying that Apple stock goes straight into contributed capital when I
No.
buy it through like NYC?
N- Um, so uh, I don't want to say this, but you missed the first lecture, right? So
Yeah.
so the first lecture we're talking about this. The company the company gets contributed capital from issuing the shares only once, and that's what when the initially shares are issued and sold on the uh, on the stock market. When the company issued the shares and on the initial public offering, that's where the company gets the cash. Now, let's pretend the Apple issue on the initial public offering. That's how it's called exactly. The terms initial public offering. That's where the company gets the money from the market. Let's say Apple sell the share for $100. Right? So now you have one share of Apple. You pay $100. The Apple get the $100. Actually, Apple's not going to get $100. Apple's going to get, let's say, $90 because then the $10 going to go to the for the initial commission of the broker and this and this and this, so many things. But let's say the Apple get $100. You invested in $100. They get the $100. Now you holding the share. So the Apple starts generating income. That income gives the investors dividend, and obviously the market price per share start increasing. Initially was issued $100. Now that market price from $100 starting climbing, getting $500. Let's pretend the market price went to $500. Now you want to cash on that. You buy the shares for $100 from Apple directly, and now you see the market price is $500. And you're selling that share to me. I'm paying you $500. Now, who get the money now?
You.
No, I'm getting the share because I'm purchasing from you.
Oh, sorry, me. My bad.
You're getting the money. You're getting $500. How much from those $500 Apple's gonna get?
No, I'm guessing zero because they already sold the
Exactly.
shares a long time ago.
Exactly. Make sense?
So is contributed capital more the stated value of shares less the expense of issuing those shares and receiving the money?
In a way, yes, you can say that.
Okay.
But the contributed capital, again, the contributed capital will be the so what's gonna be so if I initially issue the shares of $100 and I issue 1,000 shares, that will be my capital.
Mhm.
100,000 shares times $100. Now, obviously, I'm not going to get $100. I'm going to get less. Let's say I'm getting $95 because I have to pay $5 commission. Now, the $5 commission, so it's going to be cash $95, commission expense $5, contributed capital $100. Make sense?
Yeah.
And that's how it's going to be the journal entry.
Okay. Perfect. Thank you.
After that, what's going to happen on the secondary market, which is not after the initial public offering, company doesn't get anything.
Okay. Okay. Thank you so much.
No problem. Any other questions, guys?
So you will basically email me how Like,
For the questions that you sent me, yes.
yeah. Okay, good. And
Okay.
like that's not all I have to worry about. I have to also study up for, like the upcoming exam, like from like last week, like including last week's lecture. We're gonna be tested on like the concepts we learned in class during last week's lecture, like that will appear on the exam.